Hi, and welcome to Chapter 4, Personal Financial Statements. Part 1 here in this recording will be about the preparation of these personal financial statements. And these financial statements provide the following. They will describe the financial resources available to clients, mainly from the standpoint of what we call goal funding. So what resources are available to actually fund the client or your individual retirement goals, education goals, vacation goals, anything like that. How resources are acquired is really a question beyond the scope of this class, because that gets into the possible future taxation upon the liquidation of those assets, or maybe some estate planning issues. And also we can glean from these financial statements how the client has gotten to where they are today financially. What is their current financial situation? When you make a plan in any area, one of the first things you have to look at is, how did you get where you are now? History can be a great guide to understand what's an appropriate way to move forward. The personal financial statements really are combined in these three areas. We've got first the statement of financial position, which many of you have dealt with corporate financial statements before. So statement of financial position would be the equivalent of a balance sheet. And it's put together a little differently than a corporate balance sheet, but it's very similar. A personal statement of cash flows is much like an income statement, or more appropriately, even a cash flow statement. And then we have something called the statement of changes in net worth, which is really looking at a series of balance sheets, or using our terminology, a series of these statement of financial position documents. And just like when we look at a series of balance sheets for a corporation, seeing those balance changes from year to year can give us some valuable information. And when we use these, we're going to measure goals, or not measure the goal itself, but we might have established a goal, and by viewing these financial statements, we can determine how we're progressing towards that goal. As planners, it will help clients set a financial direction. So once again, any kind of plan for the future will involve the story about how did you get to where you are today, and that can help guide us as we move forward. And then these financial statements, of course, are also used by creditors and lenders to make a decision as to whether the client or the person they're dealing with is creditworthy, and it will come into the loan approval process. Let's first look at the statement of financial position. It's really made up of an assets, liabilities, and unlike a corporate balance sheet, which would have equity section, we have what's called net worth that makes up the rest of it, but that's effectively owner's equity in your personal financial situation. So this is very much like a traditional balance sheet. The items on here, we have cash and cash equivalents. These are considered to be very liquid, which by definition means they are easily converted to cash. Also, when we say cash equivalents, they're things that we're expected to turn into cash within a year. So in accounting terminology, we're talking about short-term assets here. We next have our investment assets. Those are assets that are held for growth or income and designed really to satisfy future goals. So these are the investment areas, or the assets that we hopefully will accumulate so that we can satisfy goals for the future. And then we have a section called personal use assets, which are definitely assets, but they're not seen to be available to fund these future goals. So they're not available to fund future goals. Things like your house or a boat or a car, they're things that enhance your current lifestyle, but aren't assets in a way that you would plan in the future to liquidate them to satisfy another goal. They're really lifestyle type assets. Then we also have our current liabilities, which are short-term. So current meaning short-term. We've got credit card debt, the short-term part of our mortgage payments that are due, any type of debt that's due within the next year. So once again, this is meets the short-term definition. And then we have long-term liabilities, which are debts that are longer than 1 year. As far as valuing these assets and liabilities, we take the approach of using fair market value. So not necessarily when we're talking about an asset, it's not what we paid for the asset, but rather what it is currently worth in today's market. So if you take your home, for instance, it could go up or down from where you bought it originally. Liabilities, we're going to record them on how much is currently owed on the thing. Well, that isn't going to typically go up and down with market fluctuations, but rather that principal hopefully will decrease as we pay off that debt. Here's an example. Throughout the text in this particular chapter, we use the Nelsons as our kind of test case client. And this is an example of their 2012 Statement of Financial Position. And you can see here we have our short-term assets here. We have our investable assets here, and then our personal use assets, as I described before in that order. One thing I'll note is this little notation right here. This indicates the ownership style. So JT means joint tenants. So both Dana and David own the checking account together. Dana only owns the ABC stock, for instance, and David owns the 401k. It's not a joint tenant situation. Over on the liabilities side, we have our short-term liabilities, which I'll point out there is some portion of the mortgage that's here. Mortgage, of course, is a long-term liability, but while we owe almost $200,000 long-term, what this is saying is $1,234 of that mortgage is due within the next year, so it's going to show up in the current liability section. Typically, credit card balances, even though they may be payable over a longer period than a year, credit card balances are generally treated as short-term debt. Most people, for a variety of reasons, will be better off paying off credit card debt sooner than later. So we usually record that as a short-term debt with the assumption we're going to try to get that paid off as soon as possible. Then the difference between our total liabilities and our total assets here gives us net worth. So the net worth of Dana and David currently at the end of 2012, $207,626, which means they have $207,000 plus dollars worth of assets here above and beyond their current situation with liabilities. So I about said current liabilities, but of course total liabilities is the better way to describe that. If we now compare this to 2013, so this is another, here this is 2012, and then here's 2013, it'll show us some changes. We have the same setup here, but you can see their net worth has actually grown. And we'll discover, I'll point out a few things. If we compare it back here, in 2012 David had a boat, what's called Boat A, for $25,000. In 2013, he's exchanged that boat for Boat B, which is worth more. Plus, he's acquired some personal watercraft. Dana ABC stock has gone up in value. There's just a variety of things on here that's changed. Our mortgage debt has gone down because we've made payments on that. Boat loan has actually increased because he bought a bigger boat. So over all of the changes on here, their net worth is actually gone up. The statement of cash flows is very much like an income statement or corporate statement of cash flows. It's essentially, we're going to try to describe where did all the cash come in during the year and where did it go. And this is done to understand current spending patterns, to know exactly where the dollars are going. And this will be the starting point for a budgeting exercise. Well, budgets are a planned statement of cash flow. Essentially, you can think of it kind of as a pro forma statement of cash flows, which is a financial statement for the future. And once again, if we know what current spending habits are, we can identify weaknesses and things that need to be fixed, and then make a proposal in the form of a budget that might put the client or yourself in a better position to meet your financial goals. So that's what we're going to focus on here. In the cash flow statement, we've got all of our inflows, which are going to be from income, investment income, people, other sources, random things that might come up, you sell something. Our savings we're going to set aside, and then we have our outflows. And we have a few names for fixed, variable, and discretionary expenses. Discretionary means you can cut them if you want to. They're your choice. So these are not vital items. This They're not medical insurance, or food is not a discretionary expense. Those are what we would call a fixed expense, or sometimes called a required expense, or even called non-discretionary expenses. So depending on who you're speaking to, you'll see different labels put on these. But essentially what we're trying to get at is there are some expenses that just don't change. They must be met from year to year, month to month. And then there's the variable or discretionary expenses, which can change. They're things that you could choose not to go on vacation, for instance. You could choose not to go out boating so often. You probably cannot choose to pay or not pay your medical insurance. That's the distinction. So here's their 2013 statement of cash flows, and you can see, first of all, he's got a salary of $70,000, and then he has $1050 in other income that's come in for a total inflow of $71,050. Of that, some of it went to savings. So they're putting away some for education. They are this $1050 right here that came in. Technically, they didn't put in their pocket because it's being reinvested automatically. And there were some 401k plan deferrals. So after those savings amounts, this right here, the $65,197, is what's available to cover all the rest of the expenses. We label these first ordinary living expenses. So these are all typical things: food, clothing, childcare, etc. And then we have debt payments in the next section, so credit card payments, and we like to break out the principal and interest to really see what's going on with the debt. So we've got credit card, mortgage, boat loan. Then we have insurance premiums, in this case automobile, disability, and homeowners insurance. And then $1,000 of education expenses are thrown in here. We have taxes. So FICA, these are the withholding taxes out of your Social Security, Medicare, federal income tax withholding. We have state income tax that was due, and the property taxes on their home. So total outflows right here, and you can see a negative number tells us, based on these numbers, if they're actually correct, they spent more than they had coming in. Well, not by a lot, but by $157. When we see that, what we normally then also see is consumer debt gradually growing from year to year, meaning the way they're funding this, they're essentially spending more than they have coming in this example. So that has to come from somewhere, and it's going to typically come from borrowing. And that either that or the numbers on here are wrong. They maybe didn't record $500 that their grandfather gave them, or something like that was not recorded on here. But oftentimes you will see people with this negative number here at the bottom, and that does imply that they are living beyond their means currently, and that's going to be funded by some type of debt. You'd obviously like to see this at zero or positive. If it's positive, that means there's some uncommitted inflows that are available, maybe to save more for a future goal, or to pay down some debt, or maybe do some other productive things with it. The statement of changes in net worth we take a look at to grapple with this. What is their current net worth situation from year to year? And it's really a matter of comparing the statement of financial position, or those balance sheets we looked at, from year to year and see what's going on. In this particular case, we saw that their net worth increased, but we're going to see the explanation for exactly what contributed to that here. The transactions that are going to affect this are here. So any changes in the value of assets, and that can be either way, appreciation or depreciation. You could have the value of your home go up or go down. You could have the value of investments go up or go down. Sometimes an asset is exchanged. If it was bought with cash, you're going to see that cash flow on the statement of cash flows, but sometimes it's a trade, some type of exchange. You might have received a gift or inheritance. That wouldn't show up on the statement of cash flows, but could certainly affect your net worth. And then if you gave away something other than cash, if you give cash, that's going to show up on the cash flow statement, so it would be observed and recorded there. But if you gave a car, for instance, that's a big deal right now. A lot of charities encourage you to donate your old unused car to them. And if you give that non-cash asset, that car is no longer in your personal use assets category, so your net worth is going to decline, and that transaction was not seen on the statement of cash flows because it didn't involve cash. So for the Nelsons here, you can see what's happened. And some of these details as far as where this came from, you'd have to reference the notes section on the Nelsons financial statements in the textbook. All of these numbers are directly from the Chapter 4 textbook example on the Nelsons, and they have provided some additional information about the inheritance, about the exchange of the boats, and that sort of thing. I didn't feel that it was worth getting into that level of detail here. What we're trying to understand is exactly what these financial statements tell us and what information we can glean here. So there was an inheritance of $10,000 of stock. There was some appreciation of assets here. There was an exchange. This is the boat A going away, the boat B being acquired. So David acquired both a bigger or nicer boat and personal watercraft as part of that exchange. And we've got some more appreciation of investments here that's contributing to an increase in net worth. So this first section is all additions, all the types of things that add to the net worth of the Nelsons. These are boat loan, these are debt payments or debt liabilities that are going down because of repayment. So all of these activities actually contributed to increase their net worth by $68,000 and some change. However, there were also activities that reduced their net worth from 2012 to 2013. Their checking account balance went down. Their automobile lost value. They gave away a table to their mother, which you have to dig deep into the notes in the chapter to find that one, but they gave away a $1,000 table. They no longer have boat A, and the boat loan actually went up. They borrowed more money in order to acquire, as part of that transaction, to upgrade their boat and acquire personal watercraft. So all of these come together to essentially have a negative effect on their net worth. But the net change, if we look at this, we've got a $68,104 benefit here in transactions, and we have this reduction, but the net change, and this right here, the $33,947, is what we saw up above when we took a look at the statement of financial position between 2012 and 2013. If you go back and review those two slides, you'll see that their increase in net worth is explained completely right here in the $33,947. So that's the end of part one, where we prepared the financial statements. They walk you through these financial statements in great detail in the text. If you want another review of this, I would expect you have read the textbook on this. I was just pointing out, kind of summarizing, which you should have already read. There's some end of chapter problems that deal with this topic I would encourage you to take a look at. In part two, which is coming up in the next video, we will discuss how are we going to analyze those financial statements for the Nelsons and determine what are the strengths and weaknesses inherent in their current financial situation.